what we're seeing, it suggests that we are today where we were with the internet in 1995. And 1995 through 1999 was the biggest burst in the growth sector of the market in history. It went too far, too much capital chasing too few opportunities too soon, and so it ended badly. But we're just at the beginning of this, and we're pretty excited about it, and we think that this is much more on the consumer side.
Cathie Wood of ARK Invest believes we're entering a rare moment in financial history, similar to 1995, just before the internet reshaped the global economy. Back then, markets surged on innovation and optimism, and she argues today's mix of technology and macroeconomic shifts could spark an even bigger transformation. Unlike the gloomy outlook many headlines suggest, which sees inflation cooling, productivity rising, and breakthroughs in AI, robotics, blockchain, and nuclear energy driving stronger growth. She points out that just as the U.S. turned deficits into surpluses in the 1980s and 1990s, innovation today could again fuel a broad-based recovery and challenge the narrative of stagnation. One of her boldest calls is that the U.S. is entering a new nuclear age, with small modular reactors, advanced energy storage, and deregulation unlocking dormant potential. Combined with exponential demand for computing power from AI, she believes these shifts could deliver unprecedented productivity gains and set the stage for a decade of expansion.
Just keeping our eye on this target, 3% deficit as a percent of GDP. You can see we've seen a small improvement. Tariffs are beginning to impact the deficit or improve the deficit. They're running somewhere between a $400 and $500 billion rate. That's an annual rate. And that would get the deficit over 1 year to roughly 4.7, 4.8%. So continued progress we expect. This is a lightning rod issue for the markets, and it's because the interest level is so high already, higher, as many people know, than the defense budget, that it seems that is going to be overwhelming. We won't be able to overcome this because just paying that interest bill is such a drain. And we are focused on it as well, but focused on ways to get it down to 3%. Tariffs will pick away at it, but we think much more important, besides the Doge cutbacks, which are still impacting government spending, with government layoffs featured prominently in the unemployment report. So those have a long way to go, actually. And then the other thing that we're focused on is real GDP growth. And we believe, as we've said many times before, that real GDP growth, starting later this year into 26, in time for the midterm elections, we think it's going to surprise on the high side of expectations, significantly on the high side of expectations. And so we think that is going to be probably the biggest answer to the deficit falling as a percent of GDP. This was also the answer in the Reagan years, moving into the Clinton years. There we ended with a surplus. And we do expect a surplus, maybe not in the next 3 years, but again, just like in the Reagan years, it takes time to turn the profligate spending around and correct for excesses. So within the next 4 to 5 years, we would not be surprised to see a surplus. Again, we're very dependent on real GDP growth. And as we've talked about many times in the past, we do believe that we're ready for prime time for all of the innovation platforms around which we have centered our research and investing for years. So robotics, energy storage, AI, multi-omic sequencing in the life science space, and blockchain technology. All of them are being catalyzed by AI. Of course, AI can't catalyze itself, but you know what I mean. All of the other platforms are being catalyzed, and I think the speed of change is going to be pretty shocking over the next few years. And there are shades of it, or signs of it, in the unemployment report, and we'll get to that in a minute. I just wanted to point to this chart as well, because I've just taken a trip through Asia, and it is clear that the only focus in Asia is on tariffs and those headlines, but they're not focused on the massive deregulation that's taking place in the United States. Crypto, we're seeing big changes there, of course, legislatively, and also in the court system and in the regulatory system. So there we're seeing the first executive order, I think, that President Trump rescinded, this was a Biden executive order, was on AI to free up innovation in that space. Nuclear energy, all kinds of energy to solve the power needs associated with AI and data centers. Huge deregulation, huge. Now that is slower moving by nature, but on our site you will see how much regulation has held back nuclear energy here in the United States and in Japan since the 70s. And we're rectifying this 50-year problem now at warp speed, at least for that sector. And just to give you a sense, China is constructing today 28 large-scale nuclear reactors. In the U.S., we are not constructing one. We have been so constrained by regulation. And the antidote to that has been small modular reactors, and those are proceeding apace. Again, regulation takes time, but again, proceeding apace. And we think from the largest to the micro nuclear reactors, we're moving into a nuclear age.
Still paying taxes on your crypto gains? What if you didn't have to? With ITrust Capital, you can buy and sell crypto inside a tax-advantaged IRA, giving you a smarter way to grow your portfolio without worrying about capital gains tax. That's why they're the #1 crypto IRA platform in America, with billions in tax-advantaged transactions. There are multiple ways to fund your account. You can make a contribution, transfer an existing IRA, or roll over an old 401k or employer plan. You'll get access to a wide range of digital assets, low fees, and 24/7 trading, all backed by secure, one-to-one asset ownership with institutional-grade custody. And if you have questions, ITrust Capital offers 100% US-based customer support with real people ready to help. Click the link, use code DOSE7, and get your $100 funding bonus today. Start building your crypto wealth, tax-advantaged, with ITrust Capital.
Brett Winton and I were at our last firm. Brett and his team authored a book, a big black book, on nuclear and how safe and sustainable it was and is. And then unfortunately, Fukushima happened in Japan and unraveled nuclear for yet another decade, more than a decade. Again, the regulators had the upper hand around the world. And now we're back, and so that's good. All of these are going to feed economic growth importantly during the years ahead.
Cathie argues the deficit isn't as alarming as many think, noting tariffs and fiscal adjustments are already improving it toward 4.7% of GDP. The real solution, she says, is stronger growth, just like in the 1980s and 1990s, driven by innovation, productivity gains, and deregulation, which could naturally bring deficits down. She also highlights the labor market, where AI is creating structural shift. While it may disrupt some jobs, Cathie believes it will generate new opportunities, fueling long-term economic expansion rather than stagnation.
Unemployment rate stayed at 4.3%. But employment itself, as measured by non-farm payroll, again, something for everyone in this report all the time, non-farm payroll, only an increase of 22,000. Now remember, the assumption in that 22,000 is that roughly 100,000 jobs were created by the net birth of new startups. And I don't know if that's happening. We'll see in the revision in the next, I think it's the next few weeks, we'll see that revision. That could take a lot of these numbers into negative territory. And in fact, one of the revisions took June into negative territory. And again, we have to adjust for what's going on with immigration right now. It could be that, could be cyclical, we don't know. Manufacturing was still negative. But the big news there is the work week dropped significantly. It dropped 0.5%. So not only are the number of jobs shrinking, but the work week is shrinking. That's not a good sign. And then surprisingly, tech is falling. Maybe not. We're hearing a lot of coding jobs are not there anymore. Financial services, maybe there are efficiencies now thanks to AI and blockchain technology. Business services, including temporary help, very negative. Government negative, down 16,000. On another negative note is the duration of unemployment, and I will get to that in a minute. I know we have it in here somewhere. I expect it to be there by now, but we'll get back there, and I will show you how the duration of unemployment is increasing, and it never got back to levels that we saw pre-COVID, and it's moving back up. So it's at 24.5 weeks on average is the average duration of unemployment. And if you look at the low in 22, we were at 19. In 20, before COVID, we were at roughly 10 before we shot up to 32 in COVID. So we are back up to 24.5. In past recessions, the duration of the unemployment rate has been roughly 20, so we're above that. Here's another inflation chart now into market indicators. Going nowhere as measured by commodity prices for the last 45 years. The peak was in 2007, and it was because of a lot of errant monetary and fiscal policy leaving the late 90s. So the Fed eased and eased and eased for all kinds of reasons, caused that massive inflation. If anything, I think this is going to break down before it breaks out. Here's the long-term Treasury yield over 45 years, and you can see it broke out. It's now levitating. We would not be surprised in the next, say, half year to see it go back to that 3% range, that base that you see in the 2010 to 2020 range is probably now going to be the low for this cycle. And we don't want these rates to go back to zero because that was a very unhealthy environment. We think the market's working much better now. And according to this metric, which is high yield spreads, the market is seeing very little risk out there. We think there are excesses in the bond market, and we're certainly seeing, I think this week, record highs in commercial office delinquencies. I think 11.7% was the number, higher than in 08-09 by roughly a percentage point. And yet, no problem according to this much broader based measure. We think that the search for yield out there is where the excesses are, and there's too much risk being taken in the bond market by investors. And this last chart, Bitcoin to gold, so has not broken its uptrend, but has had a setback in here as Bitcoin has settled down and gold has continued to go up. Our bet is that Bitcoin will continue this uptrend over time, but we are paying attention, trying to understand what is gold telegraphing relative to Bitcoin. So with that, I think I've peppered in a lot of innovation. I'll end with this. Brett Winton, our chief futurist, featured a chart today during our brainstorm, which compared what's going on now with ChatGPT and other LLMs, chatbots in the consumer space relative to uptake in the internet days on PCs. And what we're seeing, it suggests that we are today where we were with the internet in 1995. And 1995 through 1999 was the biggest burst in the growth sector of the market in history. It went too far. Too much capital chasing too few opportunities too soon. And so it ended badly. But we're just at the beginning of this, and we're pretty excited about it. And we think that this is much more on the consumer side.
The latest jobs report shows a mixed picture: steady unemployment but slowing job growth, shrinking work weeks, and weakness in manufacturing, tech, and finance. For many, this looks like a red flag, but Cathie would seize it differently. She views these shifts as signs of structural change, with AI, automation, and blockchain driving efficiency, even if the short-term adjustments are painful. With inflation cooling and yields stabilizing, she believes these trends set the stage for stronger long-term productivity and growth. For investors, her outlook is especially bullish on crypto. Just as the internet boom of the 1990s created trillion-dollar companies, Cathie argues today's AI and blockchain revolution could do the same for digital asset. Bitcoin, she notes, remains resilient against gold and is well-positioned to benefit from institutional adoption and its role as a hedge in a transforming economy. In her view, we're not at the end of a cycle, but at the very beginning of one that could redefine markets over the next 5 years. Do you think we're standing in a 1995 moment for markets? And will Bitcoin lead this next wave, or will traditional assets hold their ground? Let us know in the comments. For more Daily Dose Crypto news, check out these 2 awesome videos on your screen. Click now and we will see you on the next video.